U.S. Federal Reserve announces an interest rate decision, global markets react almost instantly. Currency pairs like dollar-yen suddenly spike, gold prices swing, stock markets turn volatile, and traders around the world closely watch every word from the Fed chair, because even small changes in expectations can shift billions across global markets within minutes. But why do interest rates have such a strong impact on Forex in the first place? To understand why interest rates matter so much, you only need to understand one idea. Interest rates influence where global money flows. When interest rates are higher in one country compared to another, investors may see better opportunities there. And when large amounts of money start moving toward one market, the currency connected to that economy can begin strengthening as well. This is why the Federal Reserve receives so much attention globally. The Fed controls interest rates in the United States, and because the US dollar is involved in most global trade and financial markets, those decisions can ripple across currencies worldwide. During periods when markets expect the Fed to keep rates high, traders often pay much closer attention to inflation data, employment numbers, and Fed speeches because all of them could influence future rate decisions. Even a small shift in tone during a press conference can quickly change market sentiment. Traders, therefore, monitor not only the decision itself, but also the language and guidance surrounding it. Back in 2022 and 2023, markets became heavily focused on one question: how aggressively would the Federal Reserve continue raising interest rates to fight inflation? Every inflation report, every jobs number, and every Fed press conference suddenly mattered. During that period, the US dollar strengthened sharply against multiple currencies as markets adjusted expectations around future rate hikes. Traders were no longer only watching charts, they were watching economic data releases in real time, because a single number coming in above or below expectations could quickly change market sentiment. This was one reason why major announcement days often created unusually large swings across Forex markets. One of the clearest examples of this relationship can often be seen in US dollar and Japanese yen. If markets believe US interest rates could remain higher for longer while Japan keeps rates relatively lower, the dollar may strengthen against the yen. During major central bank announcements, even small changes in tone or guidance can create large movements in the pair within minutes. This is why the currency pair is often closely watched during Fed meetings and Bank of Japan updates. But Forex markets do not only react to the interest rate decision itself. In many cases, traders are already trying to predict what central banks may do weeks in advance. This means markets can sometimes move before the official announcement even happens. Occasionally, a currency may still fall after a rate hike if traders were expecting an even larger increase beforehand. In Forex, expectations and surprises often matter just as much as the decision itself. Traders constantly compare economic data against market forecasts. If inflation, employment, or growth numbers come in very differently from expectations, markets can react aggressively within seconds as traders rapidly adjust their positions. Major economic announcements can create sudden volatility across the market. The moment inflation data, jobs reports, or central bank statements are released, traders and algorithms immediately begin reassessing future interest rate expectations. That rapid repricing is what often creates those sharp candles and sudden spikes traders see on charts. In highly volatile moments, prices can move rapidly within seconds before markets eventually settle into a clearer direction. The impact of interest rates goes beyond currencies as well. When the US dollar strengthens because of higher interest rates, assets like gold can sometimes come under pressure. Borrowing costs for businesses can change, stock markets can react differently, and international trade conditions can shift. Companies importing goods from overseas may face different costs depending on exchange rate movements, while investors may shift money between markets based on changing expectations around growth and returns. Even everyday consumers can eventually feel the effects through travel expenses, product pricing, or changes in business activity. This is why central bank decisions are closely watched far beyond just the Forex market. For Forex traders, major rate decisions and economic data releases are often some of the most important events on the calendar. These moments can create both opportunity and risk because prices may move very quickly within a short period of time. Many traders therefore monitor economic calendars, inflation reports, and central bank schedules closely before entering positions. During major announcements, spreads can widen, volatility can increase sharply, and market direction can suddenly shift within seconds. In Forex trading, price movements are not just random candles moving across a screen. Behind every major currency move, global capital is constantly reacting to growth, inflation, risk, and future interest rate expectations. This is why traders around the world pay such close attention to central bank decisions and economic data releases. Understanding how markets respond to the changing cost of money is one of the key steps toward understanding how professional traders analyze